Present.
Director Anthrop. Director Kennedy. Ms. Shine.
Here.
Mr. Davis.
Here.
Ms. Jonesy. Mr. McBold.
Here.
Chair, we have a quorum.
Thank you. We have three presentation items this morning. The executive summary of January 2024, the asset allocation, a transition plan, and the RFP on comparisons for real estate and infrastructure. So Kwaku, welcome.
Thank
And
you.
the floor is yours.
Okay, great. Well, good morning, everyone.
Morning.
And we have a couple of reports to go through to today. So we have the March performance, April performance, and then, as the chairman said, a quick update on the searches that we're presently going through. So as we think about the performance of the portfolio, the month of March was a really good period for the markets. To really sum up what we're going to be talking about momentarily, March was a period where the market rebounded pretty strongly. The Fed essentially signaled in the month of March that it was pretty comfortable with where its interest rate policy had been going, particularly around combating inflation. So the market took that as pretty good news, and we saw a pretty strong rally in the month of March. Now, the April report, we will see something a little different where the Fed, they have a pretty tough job. They then came out and said, you know, some of the indicators that we're looking at, employment, unemployment, you know, those numbers are pretty strong. So this is good news for the economy, but if there's good news for the economy, let's say employment is strong, there's a smaller likelihood that interest rates are going to come down as quickly, because if employment's good, interest rates come down, that's going to be more inflationary if rates come down. So we see in the month of April, even though economic indicators were positive, we did see the market sell off a little bit, and that's because the market is really just bent on seeing interest rates come down, and anything that kind of points to the contrary around interest rates coming down, the market is selling off. But as we've seen in May, it's been a really good month for the markets, generally speaking, and that's because we're still looking at interest rate cuts in 2024. When we think about the end of 2023, the market rallied really strongly because the market projected 7 interest rate cuts in 2024, with the first interest rate cut happening as soon as March of this year. That hasn't happened. What we are expecting is around 2 interest rate cuts, and we're potentially looking towards the fall, 3Q, 4Q for those interest rate cuts. So again, the market has reacted to that news pretty favorably. A couple of other things to mention before I go into the presentation. We are in an election year. I'm not going to put my cards on the table and talk politics, but could happily do that. But statistically speaking, when we think about politics, especially in election years, the market typically is positive. So as we think about our portfolio, how we're positioned, statistically speaking, 2024 should be a year where the market's positive. If we think about election cycles, and with the exception of 2008, we can really look at the market rallying off the strength of a presidential election. So that does bode pretty well for us as we think about the remainder of this year, even though there will be volatility in the marketplace. So with that, let me jump into the executive summary for March of 2024. We can move to the next slide, please. And on this particular page, next slide after that, this just underscores the performance of the various asset classes. And as mentioned, we're looking at strong returns coming in for the first quarter period. So 10.6% for large cap, fixed income in negative territory. But the conversation we just had around interest rates really points to why fixed income still is in that negative territory as of the end of the first quarter. So expectations were for rates to come down pretty aggressively. That didn't happen, and that's what's really led to the negative returns in fixed income. Fixed income has since rallied, so that's a good thing to see. But during the first quarter period, I think this points to where most of the performance is coming from on the equity side, as well as on the fixed income side. And in fact, the next slide puts... Oh, thank you. So appreciate that. Okay, so I want to say next slide, every single slide, which is great. So putting the performance of the first quarter into context, we see here that for calendar year 2023, the market was up over 26%. So that was a really, really good result for 2023. 10.6% for the first quarter really puts into context how strong the market bounce was during the first couple of months of this year. And then as we think about the other asset classes going down, the US market doing really well, non-US market also doing well. The big difference between the US and the non-US market has been that relative weighting in technology. So the US market, as embodied by the S&P 500, around 30%, close to a third of that is in technology. The MSCI ACWI ex-US index, around 12% of that is in technology. And the relative performance of technology over the last couple of years has been pretty tremendous. The so-called Magnificent Seven have really led the US stock market up until, well, they're still kind of leading at this point. And I, again, would point to the difference in technology weighting between the US and the non-US as we think about the relative performance between those segments of the market. Another thing to point to is the currency effect. So as we think about a US investor or a US investment, the local currency points to what the return would be in the foreign currency, and then the regular return, so EFI versus EFI local, that's the difference between the US return, which is the EFI return. Local is the foreign currency return. Once you translate those foreign currency returns into dollars, it's a smaller number, meaning that the US dollar has continued to strengthen in this environment.
Yeah, but on the other hand, excuse me.
Yeah.
On the other hand, the buzz in the international market is that they may go back to the gold standard, and being in such a high debt, they're projecting that dollar sooner or later is going to crash.
Yeah, I mean, that's a fair point. That's something that continues to be discussed. I would say in the 90s, that was a discussion, particularly as the euro was being rolled out. I think with the US dollar being the most dominant currency,
For right now.
there's always going to be a discussion around, okay, what's next, right? That's the thing about if anything's leading, whether it's a sports team, whether it's a currency, whether it's a sector, it's just human nature to look at, okay, what's going to be next? So yeah, absolutely. There are discussions around what could be next. In fact, crypto, up until the explosion in crypto, crypto was really being touted as the alternative to the greenback or the US dollar. So absolutely, we can expect to see more discussions and more thoughts around how other monetary systems can perhaps compete
But
better
you
with the
know,
dollar.
the consumer spending is down,
Yes.
regardless all the other indicators going up,
Yes.
but the consumer confidence or consumer spending is way down.
Yes, and due to the inflation, basically, the inflation that kind of dovetails into what the Fed's policy is and so on. Yes,
Thank you.
no problem. And in fact, this goes really nicely into this particular slide. So we just spoke about currency, we just spoke about inflation, we spoke about spending. This indicator here is what the Fed does look at when it's thinking about its interest rate policy. So back in this weird period of 2020, seems like so long ago now, we saw about 5 trillion from 2020 through to end of 2022 spent in terms of stimulus. That pushed up spending, money supply, the supply chain disruption, because of COVID, and then we think about energy, the conflict in Ukraine. All of this pushed prices up, price levels up in the US. So the Fed is targeting a long-term rate of 2%. And right now, any difference between where we are with the PCE and the Fed's target, that's really led to sustained interest rates that we just discussed.
Do they do year-over-year target rate? Like, are they taking the inflated percentages and averaging them out over a certain amount of time, or is it just an annual?
Yeah, so that's a great point. So they actually they show both, right? So they'll show these numbers on a quarterly basis, and they also look at year over year. On the quarterly basis, it just gives you a sense of how much expenditures have slowed down or how much they've picked up. And then year over year, it's that way of, I think, calming the market. So there was one period where year over year, we were looking at a 9% increase in inflation. And I think it went back down to like 5 or 4%. And by showing that year over year number, it meant that people shouldn't panic so much when they looked at that, 5% number. So they definitely look at both. The long-term target is 2%. And with respect to the long-term target, that's going to be a combination of those intra-periods that we just mentioned. Yep. Fixed income, I mentioned very briefly that fixed income saw volatility during the first quarter, specifically around interest rates and where interest rates are going to go. But during the final month, we did see a little bit of a bump up in fixed income. The correlation between fixed income and interest rates is very, very strong, given the fact that, the coupon or how much you get from your fixed income instrument, if rates go down, the present value of your fixed income investment goes up. And then on the flip side, as we saw in 2022, as rates go up, the present value of your fixed income instrument goes down because you can actually get a bond yielding more, essentially for the same price. So that noise that we're seeing in the fixed income market is somewhat uncharacteristic, and it is emblematic of this period that we're in right now, where again, the economy's in pretty good footing. The inflation indicators that the Fed is looking at is still not pointing to, an aggressive reduction in interest rates. That can all change. I guess one of the things I'll mention here, this is a personal opinion, that can all change the flick of a switch. If we think about inflation and these indicators that are looked at, they're lagging indicators. So if we ever enter a period where the economy does slow down tremendously and perhaps to a degree that the Fed didn't forecast, that's where we could expect aggressive interest rate cuts. And then the reverse would be the economy continues to be robust, we can expect rates to be up for a little longer.
Is that likely that it?
Yeah, I mean, I personally think yes, just because we were supposed to go into a recession in 2020, but it didn't happen. And the stimulus, the 5 trillion just mentioned, was like that sugar, rush of sugar that the economy needed during the COVID shutdown. So it's like we've skipped the recession, and somehow the books need to get balanced at some point. So I don't know if it's a breaking point with interest rates where rates are kept higher for longer and then that leads to a slowdown, or if consumption patterns or something else external does impact things. But I would say that the economy should at some point cool off a little bit, just because we avoided the slowdown that was anticipated in 2020 because of COVID and the spending associated with COVID. And in fact, to that question, that's super timely on this page, the blue line points to the yield curve. It's a lot less extreme than it was, but the yield curve is still inverted, meaning that at the short end, rates are higher than the longer end. And that's really not sustainable unless rates come down. And typically, rates will come down either in response to a recession or Fed action. So again, from a statistical standpoint, I can only point to stats and mean reversion where if something's up, it has to come down. And that is true for the economy. But as we've seen in recent years, the Fed is interventionist, and that we may have fully well staved off a recession, which again would go contrary to everything that policy theory and everything else would have us think. So more to come, but I still think it's a realistic probability to have it on the table. Recession in terms of a slowdown as opposed to like a depression or something like 2008. But again, I guess as the year unfolds, we'll get a clearer sense of how off base the assumption I just made was, or if there's a reality behind that.
Okay.
On the U.S. equity front, we are looking at, again, a really strong start to the year. One of the things to point to, which is pretty interesting, is the performance of value and growth on the large cap side of things. So I mentioned that growth stocks have done really well, the Magnificent Sevens, your Metas, your Alphabets, Google's, which is Alphabet, Tesla's and so on have performed really, really well. And they've left your J&Js and your Procter and Gambles and your more steady types of stocks. They've really outperformed them. But what we saw in the month of March was a reversal where value actually did better than growth. And when value does better, that typically is an indicator of either jitters or concerns that things are slowing down in the economy because people are moving to safer stocks, the stocks that pay dividends and so on. So, a month is too short to say, look, this is a trend, but at the same time, it's still an interesting observation with respect to the stock market. And in fact, that does kind of back up the point I just made earlier. Value segments of the market did better. But if we look at, again, the relative weighting of the US market presently, 30% is in technology. So, kind of mirroring the early 2000s, technology represented a big portion of the index. Technology still is a dominant part of everything we do. But there were many players in the market at that point, many firms going public. Some did exceptionally well. Obviously, Microsoft, Apple, there's a lot of names still out there today from that era. But, companies didn't make it. There was a dot-com bubble that burst. And ultimately, is this 30% sustainable, or is this one of the things that could potentially lead to a slowdown in the economy?
AI part of that?
Question on that part. Where does renewable energy stuff go? Is that under tech or under energy?
It would be split under both, basically. The tech component would be, either newer energies that have not been deployed or in their infancy stage. And then your traditional energy, ironically, your BPs and your Shells and so on, these are the organizations investing in a lot of alternative energies right now. So that's why it's kind of split between those two sectors. And then, did that answer the question? And then to the chairman,
The AI, is that?
yes. So that would absolutely be part of the technology. So
My pushback on that AI being part of technology is that it depends on how they're applying it. For example, in healthcare, they're applying AI to do complex things, like if you're trying to do brain mapping. There's a massive amount of data in how your brain maps signals. AI is the only way you can actually make sense of that in a reasonable period of time to come up with concierge interventions. So that would be like my question about renewable. It would sit somewhere different than you think.
yeah, so right now, and just given how they classify the sectors and the revenues of companies, so absolutely, there's always going to be cross-pollination between sectors. But in terms of how they define the companies, technology, we can think about NVIDIA or Meta or Tesla as an example. These are all companies that would fall under technology, even though they have other bits of their business doing, other things. So that's the quickest way to look at it. And I would say, again, with technology, because it's essentially evolving how we live and how we operate, technology will transform, if not all of these sectors, most of these sectors, but just given how they count the weightings and the companies, and it's based on how much revenue, 30% would include your NVIDIAs and so on.
And Mr. Chair, just a bit of housekeeping. Just want to note for the record that Ms. Johnsey is to be counted for the role as being present.
I did mention earlier, Mr. Kennedy called, he had an emergency, that's why he's
Okay.
absent today.
Yes, thank you.
Okay.
The international markets, just noted earlier, lagging the US markets, but again, the relative weighting in technology is going to be that key, driver of that dispersion across the two. So you'll see here that IT is 13%, and you'll see that on the US side, it's called technology. On the international side, it's called IT. The index providers have their very unique classifications and how they determine what makes it into each group. The index we looked at before was the S&P 500. This one is the MSCI, two different organizations. That really points to the difference in labeling. But at the end of the day, we're looking at essentially the same sectors.
How many months does it take to be considered a trend? Because we've seen a huge reversal in March. Like, when is that we're saying, hey, we think this is actually where it's going?
Yeah, I mean, I would say it's changed a lot because a trend used to be they'd say, okay, it's a couple of years, but now in like one market cycle, we can have 5 or 6 different trends. So I would say the best way to look at it or define it would be short-term versus long-term trend. Long-term trend, I think an example there would be the discussion we just had around AI. That's a long-term trend where we know, or unless they've really duped us, we get a sense that AI is here to stay and it will transform, how we drive, how we cook, how we get our healthcare services and so on. And then shorter term trends would be, let's say, core value growth, where your growth stocks, there's definitely been a trend with growth stocks to outperform. That's been a strong trend, and that's been, following the global financial crisis, even through to the COVID era. Now, if growth does pull back for a month or two, it's perhaps too long to call it a reversal of that trend. But if growth does pull back for a month or two and value does do well, we can say over the short term, there's been a new trend of value holding up. The consideration we'd want to have is there enough data out there, or is there enough convincing us to say that growth's run is over and then value's really positioned to go forward? So unlike 15 years ago where we talk about trends after a couple of years of observing, I think now, because it's a shorter period, a shorter cycle, I think it's the effect of social media where, at a heartbeat, people are jumping on, piling into stocks, selling out of stocks. Trends have just become a lot shorter. So that's my observation on that. On the real estate side of things, and actually, really good question on trend. This is an example of a page that shows 2 trends. So real estate's an area of the market that has gone through a pretty tremendous cooling off. Why has that happened? So COVID hit, and then a couple of things happened. Interest rates went up tremendously. People weren't necessarily adapting to work the same way they had pre-COVID, more flexible work schedules and so on. So as a result of that, we've seen office space come under quite a lot of pressure. And with respect to that pressure, it is about work dynamics, but then interest rates going up has really seized up transaction activity, meaning that the supply probably far exceeds the demand out there. And if people are looking to sell in this environment at the commercial level, they should be willing to take a pretty big discount. As rates do come down, it will become cheaper to finance transactions, and the discount or the spread that we see between those that have the supply and then those that are demanding should narrow. So that's one trend that we're seeing right now, and that's been since COVID. Now, if we look on the far right-hand side, even though real estate has gone through its challenges since COVID, we'll use the core open-end real estate index. 7.9% is the average annual return of the asset class over a 10-year period. So that's the long-term trend, even though the short-term trend is still looking a little bit challenging for real estate presently.
So, but as far as the office space, they are transitioning or converting into condos and stuff, so that
Correct.
it would still have significant effect.
So over the office, for the office space over the short-term period, there will be hits in the valuation, but as you correctly noted, they're looking to transform and make these properties more multi-purpose. So even though they're being sold at a discount, we would expect as the real estate market recovers, those properties, particularly if they're bought in prime locations downtown, really just helps, the younger workforce with work-life balance and things like that. You could expect to see those properties go at a premium when things do normalize. So yeah, absolutely. And I think 2008 is a really good example of that, where we saw retail, office, all the sectors essentially plummet. But then took about 2 years, but things did recover back to their prices. So yeah, absolutely for real estate.
Okay, cool.
Yes.
Is the trend back to people not working at home and returning to the office, is that going to affect or impact that real estate market?
Yeah, so It will and it won't, just because the US is so big, so diverse, and I feel that depending on which state, which city, even which organization we're thinking about, there's not a uniform answer. So certain career paths have been more accommodative of the flexible work schedule, particularly on the technology side and so on. On the manufacturing side, that's a little bit of a gray area just because of AI and so on. But ultimately, I think the discussion around what going back to work looks like will still go on for a couple of years. And some places will be, quote unquote, a little bit more old school, where, you know, if you are a first responder, you're a teacher, you're in certain professions, sanitation workers, it becomes hard to have that flexible schedule. But other parts of the workforce, I think, will continue to push for that flexibility because once you have it, it's really hard to take away. And I think that's the challenge that employers are facing right now.
In fact, there is a very big growth in tracking software's development on remote working.
Oh, yeah, that's a really good idea.
I mean, there is a huge market emerging
Sure,
for the people who are working remote
sure,
to make sure they are giving their employers.
sure. And that is not surprising. I could go off on a tangent about Gen Z and Gen X, but I'm not going to do that at this meeting. So it's definitely different adjusting to the new workforce.
You being an old man. Hollering at him to get off your lawn.
Yeah, that's definitely. I've become that guy. It's really unfortunate. And then with respect to again the question about trends, and I'll keep on going back to trends because that's what we look for, that's what we do, that's what we look to explain. Real estate, the trend we're going through right now, which is the cooling off of returns. If you look at the since inception returns of real estate, since inception is positive, and over the last 24, 25 years, you'll actually see that the green does point to a really strong trend, long-term trend, whereas the red points to a shorter-term trend that typically doesn't last as long as the trend in green. So that bodes pretty well when we think about real estate as an asset class and as an investment for this portfolio and other clients. Infrastructure is a subset of the real asset space along with real estate. I would say that infrastructure, unlike real estate, has not gone through the same challenges. Utilities, for example, have monopolistic pricing. You know, whether it's COVID, whether people are going to work or not, utilities have to get paid. Roads have to get used. Airports will have traffic coming through them. So we've still seen pretty consistent returns coming from the infrastructure space. So as we think about the asset allocation and we think about real estate and infrastructure, they're really good diversifiers and complements to one another. Private equity, only takeaway from here is it's been a really good diversifier for portfolios. The market has gone pretty, has been pretty volatile. It's gone up tremendously up. It's gone down pretty tremendously. And you'll see during that period of time, private equity has been pretty constant. So private equity is in the portfolio as a source of returns, but the goal is for some downside protection should we see more volatility in the market. Portfolio review. So I'll be a lot briefer in the April review because we touched on a lot of the main points for March. So we'll just touch on what changed between March and April. But with respect to the portfolio, nice returns coming in. Equities did well. The real estate composite, infrastructure, they all held up really well. We were in an environment where equities did exceptionally well. Equities are a big component of the portfolio, so that was helpful for us. And then fixed income, as we went through fixed income, your investment grade paper, which is your treasuries, your AAA, your highest rating type of fixed income, that did go through some volatility during the first quarter, but your core plus fixed income, able to go into corporates, able to go a little bit down the cap spectrum, as well as the credit spectrum, we did see those segments of the fixed income market perform well. So all in all, the portfolio held up really well on an absolute basis relative to the benchmark. And then if you look at the returns, we're in blue, the index is in gray. we've continued to hold up really well versus the benchmark. And in fact, this points to the performance of the various components of the portfolio. You'll see the fixed income composite, as an example, did a lot better than the index over the first quarter. And the plus sector exposure, what I just mentioned, was one reason behind that. Being able to deviate a little bit to some of the more inefficient parts of the market, or the markets that are a little bit more dislocated versus your investment grade treasuries, was definitely advantageous. And as we go across the various composites, pretty nice performance for the first quarter. With respect to performance for the first quarter period, fixed income through Pyramis held up well. The Cohen and Steers Infrastructure Fund also held up well. And then the REIT strategy, as we can see here, the REIT strategy did deviate slightly. Overweights and underweights relative to target, nothing really surprising on this particular page. As the private equity monies do get called, we're going to see an underweight in private equity, and then the overweights will be in the areas that we'd rebalance into the private equity allocation. So nothing alarming on this page with respect to overweights and underweights. This section here just points to the actions taken. I think anytime we go through changes, education sessions, manager discussions, it's always helpful just to keep a running tab of what's been going on in the portfolio. So that was just a snapshot. And once again, I think just revisiting where we are from an asset allocation standpoint is helpful. So the old allocation is on the left-hand side where you see legacy. Approved allocation is the new allocation that we're transitioning to. The arrows or the triangles in green, they point to areas where we've increased the allocation. Where it goes down in red points to areas where we've decreased the allocation. So you will see that we increased how much we have in US equities. We increased how much we have in non-US equities. That was really helped by the liquidation of hedge funds. And then with respect to real estate, we did bring down the allocation we did bring down the allocation, I should say, or I should say we did increase the allocation. We added infrastructure into the portfolio. And with respect to real estate, we did place real estate, core real estate in the portfolio, which would mean rebalancing amidst the asset classes we have exposure to. So momentarily, I'll give a very quick update on what's happening with the RFPs that were sent out and responded to. And as we think about the various phases of the search, the asset class transition, we presently have REIT exposure. We also have listed infrastructure exposure. What we are looking to do over the coming quarters, just to be mindful of time and how long it takes for a transition to take place, what we're looking to do over the coming quarters is bring forward candidates for your review and your discussion. Now, with respect to the candidates that we're essentially taking a look at.
Question, those 4 candidates, they've gone through a review and process by your staff?
Yes, so going back to the memo that we had that accompanied the private equity search, but it also was part of the real estate and infrastructure search, our research team did view the RFP responses that were received, and then they went through and sorted through who would be the best candidates for us to discuss and interview. Now, in light of the updates just mentioned on real estate, where the real estate market is, I mean, the good news is the clock isn't ticking for us to make the allocation. So it's really a case of coordinating time, finding time for us to interview the managers. But in conjunction with that, we've also conducted some searches for these various asset classes. Where we have non-US small cap, emerging markets, US mid cap, US small cap, and core fixed income. where we are essentially looking at, responses to the RFPs. We're expecting to have a written summary and search books going through a review of the candidates in the middle of June. So the thought on this end would be, once those deliverables have been put together, we would then do a refresh of the of the real estate and infrastructure managers, because the data that we looked at was as of 2023. So we'd want to just refresh those numbers for you. And then once we've gone through those refresh numbers, we can highlight which firms we think would make sense to have additional discussions with. So that's really where we're at presently with the entire search process. I would say more documents coming in June, and then following those documents being sent in June, we could establish a timeline that works to have meetings for the traditional managers, as well as the infrastructure, as well as the real estate managers. So
You're
that's
looking at the summer, the end of the summer to do that, or early fall?
I think early fall would allow folks to pace this a little bit. So I think early fall would make a lot of sense. And then
That timeline's okay for us?
yeah, I would say that would work. I think if you are all open to it, we could, for example, as we go through the candidates in the search books, like we did the last time, we can have, instead of, I think we had 4 or 5 private equity managers come in, we can always look at a smaller pool of managers coming in, so that could be more of a time-efficient exercise. We could look at, and this is where I don't know, this is illegal, this is where legal could opine. We could look at, I don't know if we can do virtual meetings, but putting those on the table where it's an informational session with managers as opposed to anything else. We can also try and be as flexible as possible to accommodate.
I think the position of the committee in the past has been to have actual in-person.
Okay, perfect. So,
Am I correct?
so we,
Person meetings. They wanted to see them face to face.
and
To
that makes perfect sense. The body language, the chemistry,
yeah.
the connection. So we can continue in person, but as we give you those deliverables in a couple of weeks, we can take your guidance on how many candidates it would make sense to interview.
Okay.
Will any of the managers like overlap in these different segments on these different RFPs that y'all put together?
So if I understand the question, would we have one manager responding to an RFP for multiple products?
Yep.
Yes, I would say one of the existing managers in the lineup, Earnest Partners, I think they responded to one of the RFPs. So it really depends on, I would say, how the managers show when we're ranking them versus their peers. So we're not out and out looking to put the same manager in different, buckets, but if the same manager ends up being just like the exceptional choice, which can happen, that would be a situation where we could have one provider managing multiple mandates in the portfolio.
Is that part of your vetting process?
Yes.
You all
so-
to look at that and
Yes.
make recommendations to us?
Yeah, so we would definitely look at that. And one thing we would also look to do is have that broader discussion with you guys, because I know some boards, they're fine having overlap. Others are like, look, we just want one in each segment. It really depends on the appetite of the board. In situations where you have one provider perhaps doing 1 or 2 mandates, it can lead to some pretty aggressive fee reductions. So just weighing all those things could point you guys in the right direction. But ultimately, I haven't seen the materials yet. Research is working on them. We may end up having a situation where there's no overlap, but we do have managers currently managing money in the portfolio that did respond to the RFPs. I can definitely confirm that.
So when we start looking at that, could you have just like total value, like if we're having these big overlaps, what value is assigned to each of those so we could kind of understand the impact?
Yes.
Okay.
Absolutely. Yes, we can definitely do that.
Is there any financial obligation on the Sewage and Water Board as far as bringing them in person?
No, it's all on the managers.
Okay.
Yeah, this is part of business development. They all have a budget, so no. So April, I'm going to be a lot quicker on April, just to be mindful of everyone's time. So April, a much different month. As I mentioned, did we conclude the discussion around searches? I just went straight into April, so are we?
I think so. That's the any other questions? I think we're good.
Okay, so we'll be looking at the middle of June to get updated information for all of you. And then we can put together a very rough timeline, subject to your approval in terms of how we could vet and interview the managers. I will say one thing, we do have passive exposure in the portfolios right now. So one of the things we'll definitely discuss is the merit of still keeping some passive exposure, even though we're looking at active managers. I think a blend of both active and passive is a really good way of keeping fees efficient, tracking error down, and so on. But that's more of a discussion for when we have the candidates in front of you. The month of April was definitely a more volatile period. And again, the interest rates, the difference in expectations between the market and what the Fed is saying is what leads to either the market rallying or the market selling off. And right now, for the month of April, we saw the market sell off a little bit. Strong economic indicators essentially meant that rates weren't going to come down as quickly as the market had originally anticipated. But across the board, we're looking at negative returns. To my point earlier about growth and seeing less technology in the international markets, we do see that the international markets relative to the domestic market did hold up better. So, this is a pretty interesting thing to look at. I don't know if we're back to where we were in the early 2000s, but there seems to be some echoes of that with technology, the ridiculous valuations. NVIDIA, they lost, I don't know how many hundred billions they lost in a couple of days, but that type of valuation that these companies have, which isn't sustainable, it'll be interesting to see what that means for the broader economy when valuations do come down. For the month of April, we saw the portfolio go down 3.4%. The index was down 2.7%, so we were a little bit behind from that 1 month standpoint. Again, as we go further out to the right-hand side, we continue to track very well relative to the index. The fixed income composite, for the reasons mentioned earlier, held up well. Equities, real estate, your risk-seeking assets did detract during that 1 month period. In terms of strong performers.
Sorry, could you go back 2 slides to the chart? You're saying compared to the index, you mean based on what you anticipated the returns to be based on our strategic asset allocation?
Yeah, so that's the gray bar. The gray bar points to just passive exposure based off the asset allocation. And then the blue bar is our actual experience where it's passive exposure, it's active management, and then we're going to be tilted a little bit different versus the index right now.
And but the index, is there like a index more broadly, like an S&P index, to see how we're actually tracking via an unmanaged?
Oh yeah, I mean, versus,
Know what I mean?
we did better than the S&P. So the S&P was down 4.1%.
Okay.
So yeah, we did do better than the broader market during that sell-off period. So I perhaps should have mentioned that. So during the sell-off period, we did protect on the downside, which is something that we do like to see. If we can do better than the market when there's a sell-off, it means that we don't have to do as well as the market when the market rebounds. That type of strategy is a lot more, a lot less return chasing, and you're taking on less risk when you have that mindset of protecting on the downside and then participating in the upside, but not looking to hit a home run to catch up. Top performers, bottom performers, infrastructure, we discussed that momentarily, where, this is an asset class that, again, has held up well. If you think about the types of assets, even in a listed infrastructure fund, these are good dividend-paying types of organizations. The REIT strategy did lag for the 1 month period. And again, looking at the overweights and underweights, nothing concerning on this page. The big underweight that we see to private markets will continue to feed or be fed by the overweights that we have in the portfolio. So the rest of this really just sums up again, the pending actions that we're looking to take. But I'd say though, with the RFPs, there were a really good number of responses. I would say for every asset class in the dozens. So it really means that we got a lot of exposure, a lot of managers really responded, and that's another reason why we're looking at the middle of June to get the data to you. So we'll highlight in our materials, the number of responses, the reasons why certain firms made the cut, why other firms didn't make the cut, and we'll make sure that we kind of show you how we pared down the list like we did the last time.
Yeah.
So this would sum up Marquette's overview, a little longer than usual, but hopefully,
That's fine.
this was helpful.
Just one question going back to the search. So we're looking at potentially 4 managers.
So we are potentially looking at a little bit more than 4. So we have on the infrastructure side and real estate side, potentially looking at 1 manager in each of those
Okay,
segments.
that's,
And then, in terms of the number of candidates?
yeah.
So yeah, we could look at 4 candidates. We could also bring it down to 3, just given the number of searches that we're going through. 3 seems like a reasonable number. And then if we look at private equity is done, but infrastructure and real estate, and then we've got non-US small cap, EM, mid cap, US small cap, and core fixed income. So all in all, is it 15 or 18? At least 15 managers that we'd review if it's like 3 apiece. So one of the things I think we can put in the email to Gray and anyone else that wants to be copied on that email is this is the pool of respondents. If we interview 3 firms per search, these are the number of meetings it would take to hire someone. If we looked at 4 managers instead, this is the number of meetings it would take. So we can definitely lay out options so that way it's as user-friendly as can be. But searches are like going to the dentist or doctor's office where unfortunately you have to do it. But it's worth it once you've gone through it.
Gotcha. Gotcha.
The doctor's
Okay.
office is great, man. Great, everybody loves coming.
Thank you again, quickly.
Thank you.
Very complete update on both, all 3 presentation items. We have 1 information item for the committee to review. That's the supplemental investment report. Do we have any public comment?
There are none.
No public comment.
Mr. Chair, I have one announcement.
Question?
On May 19th, my neighborhood, the Fallbrook Marion Improvement Association, is having their home tour. This is the first time it's coming back since the Pandorama. It's on May 19th, noon to 4. We have 7 properties featured in the Marigny rectangle. I know one of the owners, I think one of the houses is mine. So anybody that's available, we welcome you to come to the Marigny and see a little bit of our architecture on display up close.
Okay, thank you. Okay. That's all the information I have. We've covered all the agenda items. I'll entertain a motion for adjournment.
So moved.
A second?
Second.
We have a motion and a second. All in favor?
Aye.
Motion carries. Thank you so much.